Hey everyone, JasonGelios, Michigan Realtor. Very excited to be on this new platform through Zoom. Not trying to endorse Zoom, but this is pretty cool because I have a special guest talking with me today, Daniel Litvin from Advantage Lending. How's it going, Dan?
It's going really good, Jason.
This is awesome that we're able to do this. Obviously, we want to be safe, right? We want to, just not catch this COVID-19 virus that is causing quite a panic.
Yeah.
So for those of you who don't know who you are, Dan, tell us a little bit about yourself, what you do, and how you do
it. Professionally speaking, we could say I'm the owner of Advantage Lending, but the reality and day-to-day of it is that I'm a loan officer helping people to buy homes and refinance homes. And working with me here at Advantage Lending, basically you really get to, speak to me, not necessarily a manufactured celebrity. So, when someone calls in, I'm the one who's answering the phone the majority of the time and helping to set up and get the loan into underwriting, work through it, and then get you to closing ultimately.
Right. And I can also attest to that because you and I, we do business together. I've had buyers, current and in the past, that absolutely love the communication. When they actually call you, they get you, and you actually know what you are talking about. And plus, too, you and I, we go back a little bit, like decades, right?
Yeah, pretty much.
Like
pretty much.
2004, I think we met. So,
yeah.
It's my main goal with this, Dan, is there's a lot of fear being spread out there. I hate to say it, with some loan officers and some real estate agents too, where they're saying that things are getting restricted, things are getting harder. People are not going to be able to, purchase a home with everything going on with COVID-19, and things are just ultimately getting harder. And so I wanted to get an expert like you to basically talk about the reality is. Now, you and I, we're both in Southeast Michigan, but I feel that this could also apply across the country. So
I think that's very accurate. Yeah. And I know what you're saying because I'm hearing a lot of the same stuff too.
Right.
In fact, sometimes I'm hearing it from clients that I pick up because the other places can't do those loans.
Right.
I've had clients who've called from, major, that had their loan previously with major institutions that
Right.
can no longer get their loan. All of a sudden, bank C, we'll call them, right?
Right.
They raised their credit score limits, and all of a sudden somebody who had like a 679 credit score getting an FHA loan, their pre-approval is dead in the water with
Right.
that bank. Okay. It is accurate to a certain point, depending upon where you're at and who you're dealing with. When you deal with a single source lender, whether that's directly with a bank or a credit union, or possibly even there are some what they call mini correspondent lenders who basically send the majority or almost all their business to one lender. That can be the case if that one lender really kind of cuts things off and makes them different. People might find that their pre-approvals are no good, or that they're unable to get the financing that they wanted to get. But when you're a broker and not a correspondent, not a single point loan officer working for one institution, a major bank or credit union, you have options. And that's probably one of the greatest things that the broker community can do for clients is provide them with those options. So there's a number of lenders that realistically, Jason, I haven't used in a long time. They've kind of been, sitting on the bench on the back burner of my roster of lenders for a while. But the reality is that these guys have kind of now become my best friends. They're still doing these loans. I mean, FHA loans still down to a 620. There's a couple of adjustments. They're not going to get the most awesome rate, still be under 4%. But in either case, to have a 620 credit score, get under 4% of an interest rate, still be able to buy a home with 3.5% down, get the seller to pay for all your closing costs with seller credits that of course you'd work on.
Right.
It's still a great deal. And I got more than one lender like that. So that's an advantage. So, I mean, really depending upon where you're at, I mean, if people were previously pre-qualified someplace else and they found that things aren't the same, we can help them out, get them, have a conversation, find out where we're at, and go from there. So that's one of the big points is, although there's been some restrictions on a lot of the different types of loans and the credit score requirements and stuff like that, we're still getting these loans done. Okay. But one of the big things I think we should probably talk about is being employed. It seems pretty easy to think, right? Okay, well, I got my loan, I'm laid off, I still want to buy a house, or I'm laid off, I still want to refinance because it's going to better myself financially. That's not a change in restrictions. You always had to have a job and an ability to repay to get a mortgage. So even though that's being talked about a lot more, the only reason it's being talked about a lot more is because those verifications are coming the day your loan closes. I guess we could say the only change, it used to be that verification used to come within 3 days of your loan closing. Well, now they're doing it the day your loan closes. So that's the only change, but the concept's not any different. Still got to be employed. If you don't have a job, if you're temporarily laid off, we can't use unemployment to qualify somebody for a loan. We got to be able to verify that they are working. So that's one of the big things going on, but it's really not a change because you always had to have a job anyways.
Absolutely. And I think that's important for people to know that okay, just because the government's, I don't want to say bailing out people, but a lot of things have changed, and COVID-19 is not something that could have been helped. You still have to be employed, or at least, be back to work before you get a house. So,
right.
And I've always, on a personal note, I've always liked brokers better. Especially you, Dan, because you have the options. For somebody, like, I tell all my home buyers, I'm like, listen, you're better off going with a broker because you don't want to spend the time, have your credit run, have one place, like the bank on the corner, like Bank C, spend all that time with you, and then if they can't get it done, or they can't locate a great option for you, you're messed up. You're the whole process stalled to where, which I believe you and I had this happen with one of our clients where they were with Bank C and they couldn't give her the right option, and you were able to essentially save the deal because you had more options, you had more relationships in the lending industry to match up a great option. So definitely, it's just, I can't stress enough that if you go with a broker like yourself, Dan, you have more options and, quite honestly, more experience.
You're not putting all your eggs in one basket. Yeah.
Exactly.
And experience goes, I've been in this since 2001, so coming up on 20 years. And, not to say that somebody couldn't get good at doing what they're doing in 5 years, but I think there's probably a little something to be said for, having, 4 times that amount of experience. There's just a bunch more situations that have come across and, that I've had to deal with before and know how to deal with again.
Right. So I want to share with you the fact that we've been seeing a lot. I know you've been seeing this a lot too, whether it's in the media or in our industry, but the terms forbearance and deferment. And some people that I've actually spoken with have stated, oh, is that the same thing? Maybe I should do a forbearance because I'm off of work for 2 months, 3 months. And they feel that there's no consequence to it, that the government is just going to handle your mortgage for 2-3 months until we get back to work, or whatever the case may be.
Wouldn't that be nice?
That would be nice, right? In Fantasyland, that might happen, right? So can you share a little bit the difference between a forbearance and a deferment?
Well, a deferment is basically where, they're deferring your payments for 3 months. And a lot of times they're tacking them onto the back of the loan, and they're able to basically make it so that, yes, it feels as though you skipped 3 months payments, but the reality is that those 3 payments with interest got tacked onto the end of your loan. As far as a forbearance goes, a forbearance is basically where they're not tacking it onto the back of the loan usually. So the two terms can kind of almost be I guess you could say commingled a little bit, but in general, a forbearance is really where they're just giving you like a break temporarily. Right. The interest and the payments are still accruing, and then basically at the end of the break, you owe all that money. So someone might go into a forbearance to get themselves a 3-month forbearance. So they go 90 days without making payments. And then the next month they owe those 3 monthly payments plus their 4th monthly payment. So that could be really hard, especially if somebody hasn't been working. Using, unemployment's not probably going to be enough to get someone like that caught up. And, don't get me wrong. I think that both those options have their place. But if someone, I wouldn't go into either of those options willy-nilly. I would really weigh out the consequences of, your current situation and your future possibilities. If when someone goes into forbearance or a deferment, technically speaking, per the CARES Act, the servicing lender is not to report those payments as late. So if someone like me pulled a credit report, or if somebody is currently in deferment and they go to get a new vehicle at the dealership, when that credit report's pulled, it's going to look like their payments are made on time. Right. But even though it's going to have that, it is going to have a little message attached to that trade line that will state loan in forbearance, loan payments in deferment. And when you have that, it could have future impacts on your ability to get other mortgages. So for example, rates are great right now. I mean, rates are really, really great for refinancing. Luckily, I think, and I hope it continues, but luckily we still have a ton of home equity right now because there haven't been enough sales that have gone bad to really influence equity in a bad way. Right. So really we got high equity, low interest rates. It's a great time to consolidate debt and everything like that. We think that interest rates are probably going to be this way all the way through the next quarter of next year. They're going to be low. It's an election year. Even after we get past this, it doesn't make sense for any presidential person to raise interest rates, and especially for re-election, they want to keep them low. And even if we don't re-elect our current president, the new president's first thing getting in office isn't going to want to be, let's raise rates. So we pretty much expect that rates are going to be low for a while. And someone who might take a deferment or something like that, they might not be able to take advantage of low rates in the future. They may not have that opportunity to consolidate debt, do a cash out refinance, or just a rate and term, maybe shorten their term down from a 30 to a 20 or a 15, and take advantage of, tens of thousands of dollars in interest that they'd save from shortening their term of their loan. So although it could be a really good option, it does come with some consequences. And don't get me wrong, if somebody is, looking at their bank account and figuring out that, we need to spend this money in other places to live right now, by all means, you got to do what you got to do. But there are some people that are taking these, deferments that don't actually need them. In fact, there's some people that are taking refinances and doing first payment defaults and deferments. And there's a lot more that goes into it. But when that loan hasn't technically been sold to the end investor, meaning Fannie Mae or Freddie Mac or Ginnie Mae hasn't actually picked up that loan's technically not eligible for forbearance or for deferment. And what might happen is people just assume, I'm going to go ahead and do this. They stop making the payments. That house is going to be going into foreclosure. So it really depends. The end buyer of your loan, Fannie Mae, Freddie Mac, Ginnie Mae, if it's a government loan, they need to actually own the loan to be able to offer any type of forbearance or deferment.
So what I'm getting, the major takeaway from this is don't do that unless you absolutely have to. And if you have to do it, to feed your family, obviously by all means do it. But just know that there's always a consequence for doing something like that.
Right.
So that's awesome points there.
It could affect somebody's ability to get a mortgage for the next 12 to 36 months.
Gosh. Which is tough.
It is.
If rates are still attractive, like you said, which, I feel that way too. There's, on a side note here, there is optimistic outlooks from experts in my industry in our industry, where they don't feel that we're heading towards a recession. They feel that real estate is going to be the primary driver to help pull us out. I'm personally on the real estate side, seeing people still putting offers in on homes, still getting out there, even though in Michigan we're shelter in place, still see offers being submitted. I got off the phone with an agent just this morning about a house in the country on the market 146 days, and they had multiple offers when they adjusted the price a little bit.
Awesome.
Yeah, and
That's
because you are allowed to have home inspections during the shelter in place, you are allowed to have appraisals, and so I don't see a slowdown other than people hanging out for a little bit, but I don't see people dropping off, not listing their homes, things like that. I mean, there's still stuff happening. Um,
right.
which actually brings me to my next question is, first time home buyers are a niche for me. I love working with first time buyers. Um, how are first time buyers going to be affected by the brand new mortgage restrictions? I know you talked a little bit about certain things changing, but a lot of many first time home buyers are a little bit nervous because they see on the news, they see on the media that, it's going to be harder or almost impossible for me to purchase a home. What's your take on that?
At this moment, there has been a lot of talk, and and things are changing daily and weekly as far as what's happening. A lot of that talk has to do with what happens with that loan when it gets sold to the end investor. There's very little servicing value right now. Ordinarily, let's just say someone closes a loan, their interest rate's 4%, Fannie Mae, Freddie Mac buys it, they're the end investor. They actually don't get the whole 4%. 1% goes to the loan servicer, okay? And there's some drawbacks to being a loan servicer. When you're a loan servicer, if that loan happens to go into foreclosure, and let's just say this is a government loan, the loan servicer has to make the payments, 4 payments, even while the borrower is not making the payments. So the loan servicer expects those payments coming in. Ginnie Mae expects those payments coming in. And if you're a loan servicer making 1% on a $200,000 loan, and all of a sudden you're on the hook for having to make 4 payments, that could hurt. Now, multiply that. Let's just say you have this would probably be small, call it a $500 million portfolio of government loans, and let's just say 20% of those go into default. And now you got to make payments on 20% of a $500 million portfolio.
That's not fun at all.
That gets really painful.
Right.
One of the other things that's happened recently is to try to help ease the burden and pain of that, is that these lenders, the investors, Fannie Mae, Freddie Mac, and Ginnie Mae, they said, okay, you know what, we'll go ahead and we will still insure against losses on first payment defaults. And basically, here's what it's going to look like. If a loan goes into default, we're going to charge you what they call a 500 basis point premium to cover that insured loan. Basically, 500 basis points comes down to 5%. So figure it like this. On a $200,000 loan, that means that Fannie Mae and Freddie Mac or Ginnie Mae, they'll still insure that loan. But in addition to like paying a normal deductible as a bank for that service to get back the majority of their money, just like any insurance claim, right? You pay a deductible. Right. They have to pay 500 basis points, 5%, 200,000, 10 grand, right? So they got to pay, they got a $10,000 loss on that one loan for servicing it. Okay. Now, when you talk about first time home buyers, someone who hasn't owned a home in the past 3 years, technically, that just became 700 basis points, 7%. So now, instead of 10 grand, you're talking $14,000 on a $200,000 loan as a penalty for a first payment default because they were a first time home buyer. So yeah, servicers and investors are scared. They're trying to do things to make it a little bit better. I know that sounds, from our side of things, sounds really punitive actually, but it's still better to get some insurance than no insurance if a house goes into foreclosure. And those are still terrible losses. So, what the news media has done is they're basically saying, oh, look, this is going to make, impossible for first-time home buyers to get loans and everything else. That's yet to be seen, at least in my arena. And again, I don't work with all banks, but with the banks that I do work with, I haven't had anyone shut off the faucet. No one said, oh, you know what, they haven't owned a home in 3 years, can't do it. It's just the opposite. I mean, besides a little bit of credit score, tightening. And when I say a little bit, I mean, I used to be able to do FHAs down to 580. Now it's up to 620. That's still really good,
Yeah, that's still, yeah, absolutely.
So that 40-point swing, not a big deal. But we're still able to get the first-time home buyers done. It's not a matter of, it's happened, and here we are. We can't, if you haven't owned a home in the past 3 years, you just can't get a mortgage. It's not the case yet. So we'll see if that changes. Things are changing on a regular basis, but as of this moment, that hasn't actually been put in place by anyone. It's just kind of I think a future modeling prediction for what might come. And does everything that the news talk about that says what might come or what might happen come true? It hasn't. Sometimes they're right, sometimes they miss the mark, right?
No, absolutely. This is awesome information. I feel that people should definitely reach out to you. I know that you provide a monthly email that goes out. I personally get it. I love it. It provides information. How can somebody sign up to receive your monthly email so that they know what is going on?
Well, it's pretty easy. If they just want to provide some very basic information, if they want to email me a name and a email address, don't even need a phone number. I can basically just get them added right onto that newsletter.
Excellent. I definitely appreciate it. And one of the things, like you don't just work with home buyers, you also help people refinance current homeowners, things like that. So I definitely think it's extremely important for current homeowners to take advantage of the rates, or maybe cut down their term, go from a 30-year to a 15-year fixed. So I really appreciate you being on here, Dan, and actually sharing truth. I have been seeing a lot on social media and even in the news about fear. So I really appreciate you sharing real facts and the fact that things are changing a little bit, but it's nothing to be afraid of.
We haven't fallen off the cliff yet.
Exactly, which things change daily. That's why people should definitely reach out to you as well to get the latest information, even if it's just a casual conversation over the phone. So Dan, how can someone get a hold of you should they have questions, or if they do want to proceed and do either a refinance or a home purchase mortgage?
Easiest way would just be to call me. I answer my phone. So my number here in the office is area code 248-608-9120. And if they want to give me a call, I'm right here. Pick it right up, get me. Other than that, they can always email me if communication like that's not available at the time. They can email me at dlitvin@advantagelendingcorp.com.
Excellent. So guys, thank you for watching. Dan, thanks again for being here. I'm Jason Gelios, Michigan Realtor. Be sure to check out my website. Once you're approved with Dan, reach out to me. It's allabouttherealestate.com. Dan, thank you again. Appreciate it.
Sounds great. Thanks, Jason.